The stock market is sending a mixed signal this morning, and the reason why tells you a lot about where investor anxiety is right now. Futures tied to the Dow Jones Industrial Average moved higher in early trading. That index tracks older, more traditional companies. Think industrials, financials, consumer staples. At the same time, technology futures slipped. That gap between the two is not a coincidence. It reflects a shift in where investors want to be positioned, and why. For much of the past year, artificial intelligence has been the engine driving market gains. Chip makers, cloud computing companies, and anyone with a credible AI story attracted enormous amounts of money. The logic was straightforward. Investors bet that AI will generate massive profits down the road, and they piled in early. That trade worked. For a while. But when a trade gets crowded, when too many investors are sitting in the same position, it becomes fragile. A small change in mood, a single piece of disappointing news, and the exit can get busy fast. That appears to be part of what is happening in tech right now. The enthusiasm is not gone, but it is cooling, at least for the moment. And when money leaves one corner of the market, it often moves somewhere else. Today, some of it appears to be moving toward the more traditional stocks that make up the Dow. Layered on top of all of this is something that could matter even more by the end of the week: the next major US jobs report. Employment data is one of the most closely watched numbers in finance, and for good reason. The Federal Reserve, the central bank that controls interest rates, uses labor market conditions as one of its key guides for policy. A strong jobs number signals a healthy economy, which means the Fed is less likely to cut rates anytime soon. A weak number points the other way, raising the odds that rate cuts could come sooner. Why does that matter for stocks? Because interest rates affect how investors value future earnings. When rates are high, or expected to stay high, money expected years from now is worth less today. That math hits growth stocks, especially in tech, harder than almost any other sector. So the jobs report is not just an economic headline. It sits directly at the intersection of labor market health and monetary policy. And right now, both of those things are in flux. The practical takeaway: watch the jobs number carefully. A surprise in either direction is likely to move bond yields quickly, and wherever yields go, equity positioning, especially in rate-sensitive tech names, will follow. This briefing is brought to you by First Financial News. Clear daily coverage of the economy and markets at firstfinancialnews.com.